Today I'm going to do a video on analysis and interpretation of financial results. Before I start, I just want to go through the structure of your answers. You must always answer in point form, keeping your answers brief and to the point. When you're answering a question in an English exam, you're expected to write quite a lot for not that many marks. This is not the case with accounting. So answer in point form, never repeat the question, get straight to the answer. Even more important here is to always quote relevant figures in your answers. You get given marks for quoting figures, therefore you must include them in your answers, otherwise you will just be throwing marks away. In this video, I'm only going to concentrate on company-specific financial indicators. In other words, I'm not going to go through the grade 10 and 11 financial indicators like liquidity, solvency, etc. You can split the company financial indicators into three groups: shareholders' returns, secondly, financial risk and gearing, and thirdly, the valuation of your shares. Right, let's start with shareholders' returns. The first one here is return on shareholders' equity. Now remember that shareholders' equity is your ordinary share capital plus your retained income. And when we use this formula, we want average shareholders' equity in the denominator. To get your average, you are averaging your beginning plus the end. So it's half of beginning plus the end. Net income after tax is used here. The reason why you're using net income after tax is because tax belongs to SARS and not to the shareholders. The answer that you obtain from here is what you're going to compare to your fixed deposit rate. If you're earning more than the return on fixed deposit rate, then you will be satisfied, because it means you're getting more than you could get if you put your money in the bank. However, if your return is below the fixed deposit rate, then you're going to be unsatisfied, because you could put your money in the bank risk-free and generate a higher return for yourself. Right, the next one is called earnings per share. You take your net income after tax here, divided by your number of issued shares, and because you're converting from a rand figure here to cents, and earnings per share must always be quoted in cents, we're going to multiply by 100. And this shows how much money a company makes for each share that it has. Dividends per share is where you take your total dividends for the year, divided by your number of issued shares, and when it's total dividends, we're referring to interim dividend plus final dividend for this year. Once again, multiply by 100, because this answer must also be given in cents. And this shows how much of your net income is paid out to shareholders for each share. Now, if you look at something called the dividend payout rate, that will tell you how much of the earnings here the company is paying out to shareholders in the form of dividends. So you take your dividends per share over your earnings per share, and you want a percentage, so you times by 100. So this shows a percentage of earnings that is paid out to shareholders. Now, if dividends per share is low, then it means the company is retaining income. Now, I just want to go back up to here a minute. Remember, shareholders' equity is share capital plus retained income. So if the company is retaining income, it means shareholders is going to be increasing, shareholders' equity rather. If you look at this, shareholders' equity is just another name for owner's equity. And if you look at your accounting equation, assets equals owner's equity plus liabilities, we can reorder that and get owner's equity equals assets minus liabilities. So if the company is retaining income here, it means owner's equity is going to increase. And if owner's equity increases, it either means you've got more assets or less liabilities, so the company is actually worth more. That's what we talk about when shareholders or potential shareholders want to achieve capital gains or capital increase in the value of their shares, capital growth. If the company is retaining income, the worth of the business will go up, and that should impact favorably on the stock exchange. So therefore, at a later date, they'll be able to sell their shares for more and thus achieve that capital growth. If, on the other hand, dividends per share is a higher percentage of earnings, then the company is paying out the majority of these earnings here in the form of dividends. So that would suit a short-term investor, someone that wants to get into a company, get out some dividends, and then move on to the next company. Right, then moving on now to financial risk and gearing. There are two relevant calculations here. The first one is your debt equity ratio, where you take non-current liabilities is to shareholders' equity. Now this is showing how the company is financed. In other words, is it relying mainly on borrowed capital or is it relying mainly on own capital? The higher this ratio, the higher the level of risk, because it means you've got more borrowed capital, it means you've got more non-current liabilities. Now, it doesn't matter how well or how badly the business is doing, those non-current liabilities have to be repaid, and interest is also charged on them. So that is why we say that the higher this ratio, the higher the risk, because borrowed capital and interest are compulsory payments. You don't have to ever buy back shares if you don't want to, and if you're not doing that well in terms of profitability, you don't have to pay dividends. So the more own capital you have, the lower the risk. Then if you look at return on total capital employed, the formula for this is net income before tax plus the interest on loans over your average capital employed, which is shareholders' equity plus non-current liabilities. Now what you need to do with this one is compare to the interest rate on the loans to see if it's favorable to borrow or not. If your return on capital employed is greater than your interest rate on loans, it's favorable. Basically what you're doing is you're using other people's money, using it effectively and generating a higher return for the company. The opposite is going to apply. In other words, if the return is less than the interest rate, then it's not favorable to borrow because you're having to pay people more than you're actually earning as a return. Now, a lot of you don't seem to really understand whether it's favorable or unfavorable to be high risk or low risk. It's not unfavorable to be high risk, but there is one important thing here, and that is as long as your returns are good. As long as your returns exceed the interest rate of the borrowed capital, it's not a bad thing to be high risk, because as I said earlier, you're using other people's money to generate a higher return for the business. Now, when you answer a question like this, 90% of the time you have to discuss both of these calculations. So don't forget to mention both in your answers. Right, then the last lot here is your share valuation. Here I'm talking about net asset value per share. Just before I get to that, the market price of a share is the price on the stock exchange. The price on the stock exchange is determined by supply and demand. If there's a high demand for shares, then the price of the shares will go up because people will be prepared to pay more. On the other hand, if there's a lot of sellers, a high supply, then they will need to drop their prices if they want to sell their shares. Now, the net asset value is actually the real value of the share, because if you take your shareholders' equity and you divide it by your number of issued shares, you're going to show how much each shareholder would receive if all the assets were sold, liabilities repaid, and the rest split between the shareholders. Remember, net assets is total assets minus total liabilities, and shareholders' equity is also assets minus liabilities. So, as I said, this is regarded as the real value of the share, and this is a good guide as to whether shares are over or undervalued on the stock exchange. So if, for example, you are asked, would you buy or sell shares in the company? And if the net asset value is greater than the market price, that means it's favorable to buy because you're paying a lower price for shares that are really worth more. And obviously the opposite applies. So if net asset value is lower than the market price, it's not advisable to buy shares at a higher price than the real value of those shares. So as I said, these shares values can be determined whether they are over or undervalued on the stock exchange. Now just a couple of other additional questions frequently asked here. This one in particular, how many shares would an existing shareholder need to purchase to retain a majority shareholding in a company? To have a majority shareholding, you need to own 50% of issued shares plus one share. So if you're asked to calculate this, you're going to take the total of number of shares which would have been issued, multiply that by 50% and add 1, and from that you're going to subtract the number of shares that you already own. Every share has one vote at the AGM, so provided you own one more share than 50%, you will actually maintain control. Just a reminder here as well, that if in the question they mention that shares have been repurchased, once shares have been repurchased, they are retired. They may not be reissued. That's going to decrease, therefore, your authorized share capital by whatever number of shares has been repurchased. So you will make use of the lower authorized share capital if the company wants to sell all of its unissued shares. So you subtract the bought back shares, use that figure, add 50%, add one share, and then subtract the shares that you already own. And then if you're asked what amount you would have to pay, you will then take that amount multiplied by the market value or the issue price of the shares, whichever they tell you. Alright, in future videos I'm going to do some practical examples on these calculations. Thanks.